Perfect. Thank you very much for the invitation and letting me present our paper. As I said, corporate loan spreads and economic activity with Anthony Saunders from NYU Stern, Alessandro Spina, and Daniel Streitsboat at Copenhagen. And all co-authors are here in the audience, so they can also contribute to the responses. Let me dive right in. So there has been a large literature basically over the last 30 or 40 years or so that uses credit spreads to forecast business cycle activities, right? So there have been different ones. There has been term spreads, there has been commercial paper spreads, there has been bond spreads, there has been high yield spreads, and usually these kinds of tests or exercises are motivated by the idea that there are frictions in markets, either on the borrower side or on the intermediary side, that sort of amplified shocks to the economy, reduce the supply of credit, and therefore have an impact on overall economic activities. So particularly the literature in the recent 2 decades or so focused primarily on the corporate bond market in coming up with these credit spreads, particularly because of data availability. So they realized that even though probably the largest impact is coming from the bank debt market, just simply because most firms are financing themselves with loans rather than bonds, they use the bond market and the spread derived from bond markets in order to forecast economic activity. But they always had this kind of implicit assumption that's here spelled out as in the Lopez Salido et al. Paper, sort of those frictions which are present in the corporate bond market are also present in the loan market. And this is why the bond market gives us a good enough signal to sort of forecast what's going to happen in the loan market and then sort of what's then carried over into the real economy, so to speak. So what we are doing in this paper is say, look, given that we have actually now data also available in the loan market, we use that syndicated corporate loan market data and derive a new measure based on that to forecast economic developments. Yeah, and let me give you a motivational picture here. So here you can see, so we're zooming in here on 2 years, 2018 and 2019. And what you can see here in these blue bars are the year-on-year changes in industrial production, right? So you can see that here already in 2019, even before the COVID crisis started, year-on-year growth was actually going down, even becoming negative. At the same time, you can see here in the black line, this is the credit spread derived from the bond market. This is a Gilchrist-Zakrzek bond market measure that's frequently being used in the literature. And that measure is basically flat. It didn't really move much over this 2-year period. If we look at the red line here, the red line is actually the spread that we derive from the corporate loan market. I'm going to explain much more detail how we're going to do that. So here you can see that in 2019, that spread is already increasing and kind of reflecting what's actually going on in the real economy, right? And that kind of picture motivated us to look at this more closely and look at this also more formally in the rest of the paper. So what are we doing? So what I want to do is basically highlight 3 facts where I think we contribute most to with this paper. So the first fact is, so we developed this new credit spread based on secondary loan market prices. The question is this useful? And the answer is yes, right? Because most firms, as we know, even the public composite firms don't have access to bond markets, but have to rely on loans. So a measure that's even more closer to basically how firms finance themselves might be a good idea to actually look at. Second, countries outside the US, European countries, Germany, France, for example, have less developed capital markets. So they even have to rely even more on bank financing relative to bond. And then another argument would be, for example, Gotthard's law, in the sense that if over time, so it's not that clear if we use historical time series, sort of what relationships that have been seen in the past are actually also valid going forward, particularly if policies, central bank policy actually targeting these spreads, as we have observed, for example, in the bond market, even also in the recent crisis. And the key result in this paper is that the loan spread has a high predictive power for economic development. As an example, a 1 standard deviation increase in the loan spread predicts a 0.41 standard deviation decrease in industrial production, and that economic magnitude is twice as large as we would observe using a corporate bond market spread. And if you run a horse race between both, we can see that the predictive power of the bond spread actually declines basically to 0. We do a bunch of robustness tests to show that this actually is super robust and everything. So we use different economic aggregates. We use local projections to go beyond different time horizons. We have benchmark methods. We use different countries. We do out of sample tests, right? All of that supports the view that the loan market credit spread has a better predictive power compared to basically everything that we use here and so forth in the literature. The second, oops, a little too far. Okay, so the second point is that we look at not only the predictive power, but sort of what explains the predictive power. So what are the channels why we observe the loan spread has better predictive power to the bond spreads? And that's basically, we are basically informed by theory to do that. So the previous papers have mainly looked at the role of bank balance sheets in order to address that, right? So there's a weakening of bank balance sheets that decreases the supply of credit, which then sort of is reflected in economic activity. What we show here in our contribution to that point is that we show that it's actually a joint role of both borrower as well as intermediary balance sheets in order to understand this differential predictive power. And in fact, it's even the case that in the loan market, almost 2/3 of the predictive power of the loan spread is coming from borrower balance sheets rather than from intermediary balance sheets. And we can link that to well-known measures of borrower financial frictions that we have from the literature, such as differences in size, differences in age, private versus public firms, as well as rating differences. So those which we know also from the theoretical literature basically determine also sort of this sort of like the cost of capital, so to speak, of these funds. The third point that we are contributing to is that we are highlighting the fact that when we aggregate from a very disaggregate level, it might make sense to look at sort of what is the what do we learn actually from lower aggregation levels? Meaning that sort of the literature so far has used a simple unweighted mean to aggregate a spread from a bond level to an economy-wide level. What we're showing is that if we incorporate cross-sectional heterogeneity across industries, we can actually improve the in and out of sample forecasting power for the business cycle quite a bit, right? And the reason is that we're going to look at, and we document this, that there are substantial differences across industries that speaks to the predictive power of spreads. For example, some industries have higher external finance dependence than others, and those industries are actually contributing more to forecasting power. If we put more weight on those, we actually can, even in the aggregation process, increase the forecasting power of the spread. So those three are the main contributions that we have in the paper. So what do we do? So this is the data that we have. We have the daily secondary loan market data that we derive from the Loan Syndication and Trading Association. The time period is 1999 until the first quarter of 2020. We focus here on US non-financial firms, term loans, because credit lines are usually not traded. And this leaves us with about 300,000 loan months observations, which is roughly 1,200 loans per month. So we use that data to match that to deal scan, to the origination data, because we need that in order to actually calculate a price. We need to kind of know what the cash flows are. So we need what is the loan amount of that loan, what is the spread that's being paid, so we can actually get the cash flows as well as other contract terms that might be And then we also use bond information. So for most of the tests that I'm showing you here, we use the Gilchrist-Zakazek measure of credits of bond spreads that they provide on their websites. For some tests, we actually replicate this ourselves using trace and merge in data. And this basically has extremely high correlation. But we need that if we go down a little bit on a more disaggregate level. And then we have a lot of macro variables that we derive mainly from the FRED database for the US and the BEA for the industry level activities. Other questions as of now? Maybe I can stop here for a second.
We don't have a question as of now, Sascha.
Okay, perfect.
We have one question right now. So it seems like the bond market credit spread is driven by the supply side of credit, but the bank loan is driven by demand side of credit. Could you explain the reasons?
So I think so. I mean, I think I'm going more into detail. So we always also find that the intermediary side matters. We're just saying that there's more predictive power coming from the borrower side. And I think, and this is one important, I think, aspects that we look at in the paper. It's the differential, so the different borrowers which populate both markets, right? So we have a relatively little overlap between borrowers that operate actually in the loan and in the bond market, but we have substantially more, like for example, smaller borrowers, unrated borrowers, and younger borrowers who are actually in the loan market, and they are much more constrained, or could be more financially constrained in a crisis. And this is why we see the higher predictive power here in the loan market compared to the bond market, originating here from the borrower balance sheet frictions. Okay,
oh, thank you.
But I go more into detail when I come to the tests. So how do we structure the loan spread? So we do that exactly in the same way as the bond spread has been calculated. So we calculate quarterly cash flows. The loan market is a bit more different and difficult to do that compared to the bond market because the bond has a fixed coupon, whereas the loan is a variable interest rate. So it's usually a 3 months LIBOR plus the all-in spread drawn. So in order to forecast what is actually the interest being paid until maturity of the loan, we need to look at the 3 months forward LIBOR and add then the all-in spread drawn. And that helps us using the observed market price today to calculate the yield to maturity of a loan K of a borrower I at a specific month's T. So that is how we have the yield to maturity of the loan that is traded at any point in time. So in order to calculate a spread, we need to figure out what is an appropriate risk-free interest rate, right? In order to avoid duration mismatch, we do this exactly the same way. We construct the synthetic risk-free loan that has the exact same cash flow profile as the loan that we're looking at, right? So how we do that is we calculate a market price. Sorry, we calculate a market price of that synthetic risk-free loan by using the exact same interest payments, but discounting them with a continuously compounded zero coupon treasury yield curve. And this gives us the price of the synthetic risk-free loan today. And then we can use the price and the cash flow profile to derive the yield to maturity of the synthetic risk-free loan corresponding to this loan K for borrowed I at point T. Yeah? And then we can just simply construct the difference, the yield to maturity of the original loan minus the synthetic risk-free loan. And that gives us for each loan K the loan spread at each point in time. Yeah, and that is really on this aggregate. This is on a loan level basis. And in order to calculate that on an aggregate basis, we just simply calculate an unweighted average of all these loans K of one borrower I, and that gives us at each point in time T one loan spread. All right. So this is exactly the way the bond spread is also calculated. So for each point in time T, we do that on a monthly basis. We have both a loan spread as well as a bond spread, and these enter then our forecasting regressions. So how does this look like? So here I'm showing you the a time series of the aggregate spreads. So we see here in black, this is the Gilchrist-Zacharias bond spread, and the red one is the loan market spread that we derive from the secondary loan market. It has a correlation of 0.76. A large part of that is coming through the financial crisis. If we take this out, it drops down to 0.65. We observe that the loan spread is an order of magnitude higher compared to the bond spread, which makes a lot of sense, right? So granted, you might have said, oh, the loan spread should actually be lower compared to the bond spread, because usually in the capital structure it ranks higher. So within firm, that would actually be the case, right? So the bond spread would be higher compared to the loan spread. But it's exactly the fact that we have a substantial different set of borrowers borrowing in the loan compared to the bond market, that the loan spread is actually substantially higher. So as you can see here, you see a higher volatility of the loan compared to the bond spread. And if you were to plot that also according to different risk rating categories, you would see that, of course, if we go down the rating categories, the spread, of course, goes up, but it also becomes more volatile. And that also kind of explains already why we see going forward that there's, of course, more predictive power in the lower rated categories as opposed to the higher rated ones. And you can see here also the differences, right? Because while the bond spread is already coming down to the pre-crisis level after the global financial crisis, the loan spread remains highly elevated. So there are differences in the loan market, which points to financial frictions. And we are highlighting that they are due basically because of borrower balance sheet frictions. I'm going to show you more about the differential borrowers in a few minutes. So this is our basic forecasting regressions. This is also something that we can basically rely on the literature and doing that. So the left-hand side is the change in the economic variable. So it's the log growth rate of industrial production. So all of the results I'm going to show you is in terms of industrial production. The paper also has other macro variables. And we have that in the months T plus H. H is our forecasting horizon, and the results I'm showing you is always a 3 months forecasting horizon. So what we have here is then the growth rate of the dependent variable, and we have different lags, which we calculate based on information criteria. And then we have here the change in the spread that we use. It could be either the loan or the bond spread. And then we have 2 other measures that we have that the literature has shown has substantially impact on macro outcomes, which is on the one hand the term spread, as well as the real federal fund rate. We estimate the regression based on OLS. We use new US standard errors, and the coefficients are standardized. I'm going to show you, which facilitates the interpretation of the coefficients. So this is exactly the forecasting regressions that you have seen in other previous papers as well. And this is our baseline results. So again, we have industrial production on the left-hand side, forecasting horizon of 3 months. And then we first include the loan spread, the change in the loan spread first, then the bond spread, then we run a horse race. And what's important is on the one hand, the economic magnitude, but also what is the incremental, oops, sorry about that. Some issues with my, okay, here we go. I'm sorry about that. The incremental R squared, which means that what is the incremental predictive power on top of a model that does not include the loan or the bond spread? So this is our main result. This is the result I've already mentioned in the motivation slides. So one standard deviation increase in the loan spread decreases the industrial production over the next 3 months by 0.41 standard deviations, right? And this is economically large. And it's also the incremental R square is relatively high. So it's a 15 basis point in a percentage point increase relative to the benchmark R square model. If we include this change in the bond spread, we can see that the coefficient is in economic magnitude basically half of what we have in the loan market, but you can also see that the incremental explanatory power in the forecasting model is also only 3.5 percentage points. And if we include both of them together in a horse race, the economic magnitude of the loan spread does not change, but the bond spread basically goes down to almost zero. So that's why we're saying, look, there's more information in the loan spread, so it has more predictive power as compared to the bond spread. And we see this in other economic outcome variables as well. So all of that is an in-sample forecast. We also have an out-of-sample forecast in which we use 150 window training windows, so to speak, and then have rolling regressions. And also here, the rolling window root mean square error is smaller for the loan spread as compared to the bond spread. So also in an out-of-sample sense, the loan spread performs better than the bond market spread does. And we also do that for different forecasting horizons. So we use local projections. So this is again the industrial production as an outcome variable. You can see here, this is the 3 months predictive power that I've shown you here. But you can see even if we extend that to a 12 months horizon, the forecasting power of the loan market is still larger compared to the bond market, and also the magnitude doesn't really change much. So let me stop here after this basic results and see whether there are more questions.
Yeah, there are 2 questions, Sascha. The first one is, why not look at within loan market variance in spread, in addition to the average level? This can help with your prediction.
So you can do that. I don't think that we did that. So we currently what we actually did is basically relying on the previous forecasting literature and basically using a change in spreads in order to do that. But you can also do something else. So I just honestly, we haven't done this, but we could of course do that.
Sure.
Yeah. And
go ahead, please.
And that you can, and this, I think this is sort of what I meant. If we go down and separate this out by rating categories, where we have also more variation in the credit spreads, you can see that the forecasting power is also higher. Okay.
The second question is, how much of the baseline results is driven by the crisis episodes?
I come to that in a second. So I'll just refer this to it 1 minute in the future, so to speak.
Sure. The third question is basically mine. So you state 2 reasons why loan spreads are a better predictor of than bond spreads. The first reason is there are more firms available and the second is it also gives information about the intermediary financial health. Am I getting it right?
I completely didn't get the second part of the question, but the first one, so it's not about the number of the borrowers in the loan market. So it's really, so we look at that from basically across different factors. We look at sizes, we look at different measures of financial constraints. So it's basically really the difference between the loan and the bond market borrowers in terms of characteristics, but not the sort of number of borrowers. Okay. And the second one was the intermediary?
You also talk about the intermediary financial health.
Yeah. I'm going to do that also. So we were relatively, so we the second part, after establishing the basic result that we see this higher forecasting power, we look at sort of what the channels are, and then we look specifically into the intermediary as well as the borrower balance sheet channel.
Yeah. Okay, we have also one more question, Sascha. How does the spread change around covenant violations, and is there an association between the frequency of covenant violations and spread?
So we don't look at covenant violations. So in this paper, we're basically looking at a very aggregate level. So we're not going to look at that more on a firm by firm or loan by loan basis. What we're going to do, which at least address potential concerns that you might have here. We have a robustness test in which we kind of construct a loan spread which is orthogonal to contract terms. To some extent, that also includes, of course, covenants or covenant strictness or something like that. And we find the exact same results. So I don't think that the results are driven by specific terms such as or covenant violations and so on. But the overall, the paper here is really more on the macro level rather than on the loan level.
Okay, thank you.
Sure. So here we are at the robustness, and here also exactly on the financial crisis issue that you were highlighting before. So what we do here is, first of all, we look at what are potential alternative spreads that also might have forecasting power. How does our loan spread compare to those? And we do that again, particularly by comparing the incremental R-squared to the measure or to the baseline model where we only have the loan spread included, which had the 15 percentage point increase. So we use a different spread that have been used in the past. We use a BBB, AAA spread, which also has significant predictive power, but the incremental R-squared is basically half of what we have, right? Or there's literature on we can use a high yield spread, so it could just simply be or only be about risk. So if we just go down the quality of the bond market borrower, then we might get a similar result. But we see while there is forecasting power, it is more so than the average GZ corporate bond spread, but it's still substantially lower compared to what we see in the loan market, right? So risk does play a role, but here it's not sort of highlighting everything which going on, meaning all of the frictions that the loan market borrowers face relative to the bond market borrowers. Another measure could be, someone could argue that the equity market could be equally informative. So we use an S&P 500 return, see that a higher return also predicts a higher industrial production going forward, but also the incremental predictive power is also lower compared to the loan spread. This is what I meant. We adjust for contract terms. So we can construct a loan spread which is orthogonal to contract terms. So basically has the borrower characteristics included, so to speak. And here we can see that it's still almost of similar magnitude, both in terms of economic magnitude as well as in terms of the incremental R-squared. So now to your question, what happens or to what extent is this driven by the financial crisis? So if we exclude the 2007 to 2009 global financial crisis period, we can see that the predictive power of the loan spread goes down as well. It's still substantially, it's still significantly negative in all senses predictive power, but the power of the bond spread basically goes down to zero. And the interpretation of that would be, particularly with respect to the bond market, that this seems to be more like a predictor of tail events, where we see what we have seen in the global financial crisis, but less so of regular business cycle movement, so to speak. Yeah. So for the bond market, directly to your question, all of that predictive power, at least in our sample period that we look at, is coming from the global financial crisis period. So we do these same types of tests for Europe. So we get the same results if we look at France, if we look at Germany, if we look at the UK. And we do this also on an industry level in which we use a different, so we basically construct the measure not on the economy-wide level, we do it a little bit on a disaggregate industry level basis. We have 11 industry types and we get the exact same results. I'm coming back to that a little bit later as well. Okay, so these are our robustness tests. Okay, so let's look at, if there are no questions at this point, let's look at what drives that. So what are the mechanisms that can explain this differential predictive power? And the literature gives us actually a few examples, and we particularly focus on the intermediary balance sheet as well as the borrower balance sheet channels. So the key is, so there's some theory that sort of guides this idea that borrowers which are more dependent on banks might also experience a reduction in the supply of credit if there's a shock to the intermediary sector, right? So the shock to the health of the intermediaries, rollover risk, frictions in raising new capital. So all of that could contribute to banks being less and less willing or able to provide more credit to the economy, and that might reduce the credit and increase the cost of credit. And this is exactly what we might observe in the spreads. So the first test that we do is to get an idea whether the loan and bond spread are related to measures of credit supplies in general. And we use two measures to do that. So we use the senior loan officer survey first, and relate the change in the loan spread and the change in the bond spreads to the measure of whether the loan officers responded a tightening of supply within the same quarter. And what you can see is that the change in the loan spread is substantially more related to a tightening of lended standards as compared to the bond spreads. If we include both together, then the bond spread again goes down to zero. So this is the first piece of evidence that a change in the spread is sort of goes hand in hand with the reduction in the supply of credit as well in this particular quarter. The second measure that we use are outstanding bank loan commitments, which we get from the call reports from the Federal Reserve, with the idea that if at the beginning of the recession, banks can actually reduce the exposure of a single borrower by actually reducing the access of credit by cutting down credit lines. And this is something that we have also observed last year at the beginning of the COVID pandemic, that particularly for small borrowers, banks were cutting down the credit lines because large borrowers have already used those. So there seems to be a good measure or a good proxy for the supply of credit. And we see this a similar result as with the senior loan officer survey. The loan spread again predicts a substantial reduction in the loan commitments, the bond market not. And if we put both of them together, we see exactly the same finding. Right? So this is consistent that there is a procyclical reduction in the supply of credit if there is a shock, which we measure based on the change in the loan spread here. So that's our first test. So there seems to be a reduction in the supply if there is a shock to the loan spread. So, the second question that we asked, can we relate this then to some measure of health of the banks themselves? Right? So we use two measures of bank health here, both from the income statement, so to speak. On the one hand, the profitability, so the return on assets, and then the the quarterly loan loss provisions that these banks charge in the income statement. And we see a relatively similar picture as on the last slide. So an increase in the loan spread is strongly correlated with a reduction in the profitability of the US banking sector. So we get these data, let's say this. This is data that we derive from the SNL index of US commercial banks. So the bank profitability goes down if we observe an increase in the loan spread, but not if we observe an increase in the bond spread. So again, the loan spread seems to be more related to bank profitability. And we get a similar result if we look at loan loss provisions. An increase in the loan spread is substantially more correlated with the loan loss provisions as opposed to the bond spread. So the loan spread overall seems to better reflect balance sheet frictions of intermediary and therefore reduction in the supply of credit. So this is the first piece of evidence that the intermediary side is important. Now, the second test that we do, and that then is related specifically to what also Gilchrist-Zakrzak have been doing in their work, we decompose the credit spread into two components. One component is a so-called predicted spread, the S hat here. And one component is an excess premium. So what do we do? So we decompose that, the credit spread, and we regress the credit spread on borrower default risk. So we have, let me go into that directly. So we regress that on the distance of default of the borrower. And we regress that, and the fourth column here is the one that we use in the test, and we regress that on all of the loan terms which might be relevant, on the spread, which might be relevant with respect to and correspond to the default risk of the borrower, which is the loan spread, the all-in spread drawn, the age of the loan, the amount of the loan, is there collateral being pledged, is there covenants, if it's the senior loan, yes or no. And this gives us a predicted spread based on these measures. So that predicted spread is actually a measure of the expected default risk of the borrower. So we use that predicted spread and take the difference between the observed loan spread and the predicted spread. And this is the so-called excess loan premium. So that's basically a measure of the price that's being charged for the default risk of the borrower. And that's basically exactly also in accordance how this has been done in the bond market with the predicted bond spread and the excess bond premium. And the excess bond and excess loan premium, it's basically reflecting the balance sheet frictions of the intermediary. That's the idea, that if there is a shock to the intermediary sector, then for any given risk of the borrower, they will charge a premium, and that's reflected in an increase in the excess loan as well as the excess bond premium. So the idea then is, okay, let's put them into our forecasting regressions and look at what kind of, or which part of the credit spread is actually more, has more power in predicting our industrial production 3 months down the line. And this is exactly what we do here in the first column. We regress again our change in the industrial production over the 3 month period. Here on the predicted change in the predicted loan spread, the change in the excess loan premium, as well as the other component that I've shown you before. And what we see is that, first of all, in economic magnitudes, the predicted loan spread appears to have more predictive power compared to the excess loan premium. And if we calculate that, what is actually the percentage contribution of the predicted component, we see that's basically 2/3. So 67% of the change in the industrial production is actually driven by a change in the predicted loan spread, and the rest is driven by the, among others, by the change in the excess loan premium. All right?
We have a question. So the question is, isn't it the case that the intermediaries borrow also from the bond markets? Don't you think that the average spreads the intermediaries face will be even more informative as it incorporates the market's assessment of the intermediaries' health, which might be a more robust measure?
Okay, so I mean,
only 4 or 5%. Only 4 or 5% of the liability structure of banks is coming from bonds. The vast majority is debt liabilities like deposits. So it may be an effect, but it'd be very small. Sorry to interject.
No, absolutely, it's perfectly fine. Yeah. So I was having actually a different argument, but that makes a lot of sense. So my argument here would be that it could be so, but this is also not our focus. I think what we are doing, I think what we can say in the paper is kind of okay. We see that there is a higher predicted power coming from the predicted loan spread as opposed to the ELP or the excess bond premium, and therefore, this motivates us to look at, okay, what can we say more about the borrower balance sheet frictions? I think we cannot say anything really about the much more than about the intermediary frictions here, right? So we see that the impact is smaller, but we don't really test or go deeper into what is the predictive power of the excess loan versus the excess bond premium. So this is not the focus here. So given the fact that 2/3 of the predictive power is coming from the borrower's balance sheets, we're actually going forward focus on that. Right, so this is one of the caveats that we have. Right, so we can't see. So you might be right, but we couldn't speak to that in this paper at least.
Okay,
and sure. And if we include all of that together, we see that again all of the predictive power is basically coming from both of these loan spread component. And again, most of that is coming from the predicted component. And that motivates us to go more deeper into the question, okay, what can we say actually about borrower balance sheet frictions? And can we relate this result actually to a well-known measure of financial frictions on borrower balance sheets. And this is why we focus on that in the next step.
Okay.
So
we have another question, Sascha. So, are the results on predicted and excess credit spreads symmetrically driven by crisis episodes?
So we have in the appendix of the paper, we have a test that looks at, so kind of we implicitly assume that it's symmetric for increases and decreases in the spread. So we look at that, and it appears to be that it's relevant also for decreases in the spread, but it seems to be the predictive power seems to be larger if we focus on the increases in the spread. So basically in a worsening of economic conditions. That's right.
Thank you.
So the second part that we're looking at is, okay, what can we learn about the sensitivity of borrower balance sheets in terms of this predictive power? And we know from the literature here that the agency costs of borrowers contribute to the wedge, to this external finance premium, to the difference between their internal cost of funds and what they would have to pay in the credit market, and also to this financial accelerator that a shock to the economy might be amplified because there's a procyclical reduction in the supply of credit based on the weakening of borrower balance sheets. So we want to find evidence that consistent, but look at evidence that might be consistent with these types of theories. And let me now tell you a bit more about how the borrowers look like in the loan and the bond market, right? And here you can see on the top the distribution in the loan vis-a-vis the bond market in terms of age. And you see in the bottom panel the distribution in terms of size. And you can see that there is relatively little overlap. So the loan market borrowers are younger, about 30% are younger than 5 years, and they're also smaller. And that 67% of those are actually smaller than 2 billion in asset size. But still, one thing to consider is this is a secondary corporate loan market, or the secondary syndicated corporate loan market. So even the average borrower in the smallest category of below 2 billion asset size, it's still 850 million in total assets. So this is quite large. So this is sort of to keep in mind what kind of borrowers we're dealing with here. But bottom line is that there is relatively little overlap, apparently, and the loan spread might therefore capturing more borrower balance sheet frictions, given that we deal with more younger as well as more smaller firms, based and those have been shown to appear at least to be more constrained, financially constrained. So we exploit that and we do different tests. And the one that I'm showing you here is again the industrial production on the left-hand side. And here it's basically kind of a double sorting, right? So we construct the loan spread measure for firms that are small and young, large and old, as well as private. And what we see here is that the highest predictive power, both in the magnitude as well as in the incremental R squared, is coming from the firms which are small and young and which are private, right? But there's only a relatively small contribution to the explanatory power, and also economically small and also statistically borderline weak contribution to the old and large firms, meaning that in an overlapping sample of firms which have both loans and bonds outstanding, we would not appear to get much predictive power, right? So it's really and this goes back to a question that have been asked relatively at the beginning of the presentation. Why do we observe these higher predictive power based on the borrower balance sheet channel? Because the borrowers are substantially different, right? Because we have these younger, smaller, unrated firms that are more financially constrained, and they appear to be more affected by a decrease in the supply of credit if there is an economic downturn. And I think this result speaks very directly exactly to that fact. So in addition, of course, we can also look not only at size and age, but we can also look at the risk distribution, right? And what we do is we look at the different rating categories that we have both in the loan as well as in the bond market. And you can see that in the bond market, the largest fraction of the bond market borrowers actually have a BBB rating or higher, whereas this is only a very small percentage here of the loan market borrowers. Most loan market borrowers are actually unrated or have a lower non-investment grade rating with a peak here in the BB as well as the single B rating categories, right? So again, we have relatively little overlap in terms of borrower based on their rating categories. And that's exactly reflected also in our results that, again, industrial production on the left-hand side, if we aggregate spread based on rating categories, the BBBs, BBs, single Bs and belows, or our unrated loans, we see that in this category where we would observe the largest overlap, the BBBs, here, those borrowers, the predictive power is not there. It's very small in terms of incremental, it's insignificant and small in magnitude. So those guys are supposedly less financially constrained, might have more access to alternatives, could be, given that investment grade could be the commercial paper market, and therefore might not be that much dependent on the loan market when there's a crisis. But here, if we go down the rating categories, as you would expect, if there is a flight to safety, those loan market borrowers with a lower rating might be more impacted. And that's exactly what we see. The lowest rated category has the highest predictive power, both in economic magnitude as well as in terms of its incremental aspect, right? And here, the not rated ones, of course, unrated have no access to bond markets, likely no access to commercial paper markets, but there might actually be a different distribution of risk, which we don't know. But we see that here again, there's a very high predictive power here as well. And so it appears that the repricing of risk might again be better reflected in the loan as compared to the bond spread. So these are the, let me give you a brief summary. So I think, and that is, I think, which is one of the contributions that I highlighted at the beginning, is that the evidence that we show is consistent with a joint role. Both borrower as well as intermediary constraints might be important. And we focus more on exploring the borrower constraint, because this is, I think, what our data set actually allows us to do. If we were to focus only on the bond market, those guys which are already the least constrained ones, we would not be able to test actually these predictions that we have in terms of financial frictions. But those loan market borrowers, here we can exploit the wide range of size differences, the wide range of age differences, rated versus unrated, private versus public. And we can observe that these borrower balance sheet constraints actually do matter in terms of their access to the supply. And that has substantial important implications and shows that there's a higher predictive power for economic activities, because we know that these firms are eventually more constrained when the financial crisis hits. So I think this is let me stop here for a second, because before I go into the alternative channels.
It looks like we don't have a new question, Sascha.
Okay, then let me continue. So there are other channels that might be potentially important to understand this differential predictive power. And the literature suggests actually two of those. One channel could be an uncertainty channel. So there might be, given that there's uncertainty as to how the economy might develop, this actually has an impact on how also borrowers invest. So it's sort of more like a demand channel in that sense. And the second channel could be an investor sentiment. So there has been literature before that has shown that investor sentiment might actually change economic outcomes, and that could also have an implication. So let me discuss both of these in turn. So the first test is, or the first set of tests is that we try to benchmark our results against a different set of proxies for economic uncertainty that we've known in the literature. So we use a volatility index, we use the PVS index for private firms, we use economic policy uncertainty index, and we use other indices, financial dependence index and the recession index from Brian Kelly's work. And we show that most of these, except the economic policy uncertainty, actually has some predictive power, that an increase in volatility, an increase in uncertainty is actually associated with a decrease in economic activity and industrial production in the 3 months down the road. But I think this is most important here, is that our loan spread remains fairly robust across all of these uncertainty proxies. So even accounted, so the uncertainty explains to some extent, but it cannot explain the incremental predictive power of the loan spread that we observe and that we find here in our tests. So this is the first set of tests that we do. A second test is a test whether economic or market sentiment can explain these results. And there's been some literature, both on the theoretical front, but also empirical, that says, okay, that could be that based on this investor sentiment, credit spreads are too narrow if there is an economic boom. And if then the situation turns and there's a downturn, then you see exactly the same overreaction into the opposite, in the opposite direction. And that's sort of exactly what we are measuring. So our idea here is that, and this is a really pure qualitative explanation of that, of course it could be that, or it is the case that investor sentiment is important to understand the credit spreads themselves. But the focus of our paper here is to understand what is actually the relative predictive power of the loan vis-a-vis the bond spread. And our earlier tests, particularly the decomposition of the spreads, has shown that the part that is on top of the expected default risk, the so-called the excess loan premium or excess bond premium, has relatively little predictive power. And this is why, and that's exactly what the literature argues would the sentiment actually be. So this should reflect the sentiment that the loan spread contains, meaning that the borrower fundamentals that we have described before, they are the ones which drive the relative predictive power of the loan vis-a-vis the bond spread, but not the sentiment, which might be important, but it's not sort of explaining the relative predictive power that we have our focus on here. So this is how we speak to these two alternative explanations. The last set of tests that we do is motivated by the question, can we improve actually the predictive power of the loan spread by looking at a less aggregate version of it? And I already mentioned when I described the baseline results that we can, instead of aggregating our loan spreads up to the economy level, we could actually do that on an industry-specific level and then get relatively similar predictive power of the industry-level loan spread and also relative to an industry-level bond spread. What we do here is we actually exploit some industry heterogeneity. And so what we do is we constructed this loan spread, and here we do that on an industry level B at a specific point in time T. And then we interact that with measures of external financial dependence. So we borrow this from Rajan Zingale's work on how to measure external finance dependence of firms. And we differentiate our industries by, for example, what are the top 5 industries that have the highest external finance dependencies? We use a continuous measure of external finance dependencies. And we look at what is the top 3 industries with the highest external finance dependencies, what are the middle 4 industries, and what are the bottom 4 industries. And then we look at what is the impact of these loan spread in these industries for the industrial production, again, 3 months down the road. And what we can see here in the first column is that the industry level loan spread, if we are in industries with the top 5 highest external finance dependence, we see a substantial reduction in economic activity in the next 3 months. And we do see a similar effect when we use a continuous measure as opposed to the top 5 versus the bottom 6, so to speak, right? And in the third column, we put in the top 3, the middle 4, and the bottom 4. And this is what we would expect. So we see some kind of linear decrease. The top 3 external finance dependence industries have more predictive power for economic outcomes as opposed to the middle ones. And then the industries with the lowest external finance dependence actually have no predictive power whatsoever. And this is very much consistent with our borrower balance sheets result that I've shown you before. Those firms are less constrained, so they have other options to raise finance, and then they might be less affected if there is an economic decline in the economy, which reduces the supply of credit to these other firms. Right? So there's substantial industry heterogeneity. So now, and the second, and this is then also the last step that we do, is we look, how can we use that information, right? How can we use that information in our aggregation process? And as I mentioned earlier, that the way in which these bottom-up loan spreads are calculated, or bond spreads are calculated in the literature, it's just an unweighted average across all loans or across all bonds at a specific point in time. So we asked ourselves, okay, if we know that on an industry level, there might actually be substantial variation across which industries have more or less predictive power because of the external finance dependency. So if we use that and change the weighting, the weighting algorithm, if we put a little bit more weight on those firms or those industries which have more external finance dependence, can we actually get to a better aggregation mechanism and a better aggregate spread that has higher predictive power? And that's exactly what we do in the last test. So from comparison in the first column, I have again the baseline result that we have. And then in the second to fifth column, we change our weighting algorithm a bit. The first one, we actually use, we put more weight on those industries in which there's a higher contribution to the GDP. We put more weight on those industries where we observe a higher heterogeneity. We put more weight on those industries where we have a higher external finance dependence measure. And here we actually, in the last one, we use a kind of very simple machine learning algorithm in which we let basically the algorithm decide where to put more weight on it. But we basically give as an input factor exactly the industry level spreads. So what we observe here is that, except for those, and which might be an interesting finding in and of itself, if we use weighting based on who contributes more to the GDP, we don't get actually more predictive power as compared to just a weight, just a simple average weighting. But if we focus more on the differential predictive power across industries, then we actually have an increase in the predictive power, both in terms of economic magnitude, right? So if we put more weight on the different industries, if we put more weight on higher or lower external finance dependence, or if we let the algorithm decide what to do, we see an increase in the economic magnitude of the coefficient. We observe an increase in the incremental R squared. And importantly, we see actually a reduction in the out of sample root mean square error. So even on an out of sample prediction, our other weighting scheme actually performs better as opposed to an unweighted measure that we normally use. So I think bottom line is that it's an interesting exercise to think about what kind of weighting mechanism can we actually use in order to increase the forecasting power when we aggregate from a micro to a macro level. Right? I think that's basically what we wanted to do. Yeah, and then I think that's all. That also always almost at the end, so to speak. Sorry about that. So let me just go briefly about what we have shown and how we think about sort of like going ahead. So I think the key result that we have is that we have this new loan market-based measure, which I think is highly valuable, given that actually originates from a market which most borrowers also in the US, also of the public firms, actually depend on. And we show that has higher predictive power as compared to all sort of like credit spreads, also equity returns that we observe or that we have used in the literature so far in terms of economic activity, sort of in terms of predictability. And we have, and I think this is one of the key contributions that we could actually show that this higher predictive power is driven by borrower balance sheet frictions and link that to the different measures of financial constraints that we know of: size, age, rating, private versus public, and so on. Right? But of course, and then this is an important part as well, of course, the intermediary constraints also play a role, but in terms of the loan market, to a lesser extent, in order to understand the relative predictive power of the loan vis-a-vis the bond spread. So why is this? And I think this is overall not only super interesting, but also really important. I highlighted a little bit at the beginning the fact that, okay, what can we actually learn from this historical kind of information or historical relationship that we have observed, for example, between the bond spread and economic activity. We have observed that during the European sovereign debt crisis in Europe, we have seen this now in the last year in the US, that the Federal Reserve or other central banks more broadly start targeting different asset classes. They are buying corporate bonds. They have done this to a large extent in Europe already since 2016. They have started in the US. And if you look at the credit spreads, I haven't shown you a picture here, but if you move the credit, the loan, and the bond spreads into the pandemic period, and what you would observe is that the bond market-based spread, it went relatively fast down to actually below a pre-COVID level. While if you look at the loan spread, it actually remains highly elevated. And that's particularly driven by small firms. If you look at the firm size distribution, and this is particularly driven by riskier firms as well. Right. So, and the key question that you could ask is, so why is this the case? And one hypothesis would be that the purchases done by the Federal Reserve in the bond market has a substantial impact on the spreads in the corporate bond market. But then the question is, what does it tell us then going forward about the fundamentals of the economy, and to what extent can we actually think about the predictive power of a bond spread if it's targeted by central bank operations? I think this is a really interesting question to actually work on going forward. What is actually the implication of targeted policy response for the predictive power of the credit spreads that we actually use these days? And I think a second part that relates much to what I just discussed in the final table is, of course, how can we make use of more disaggregated information? For example, we basically did this on a relatively broad industry level with 11 industries, have observed some heterogeneity, and then use that in an aggregation process. You could, of course, do that in a very different way and be much more detailed about this as well. Yeah. Similarly, what we've done is we've stayed at the macro level and have shown that there's substantial predictive power of the loan spread for economic cycles. We've done that also on the industry level. But of course, and that was actually one question that came much earlier, what's actually on the loan level? What's actually on the firm level? Can we use the loan market spread to actually predict measures which are actually more relevant on the firm level in terms of investments, in terms of employment, in terms of covenant violations? There's a lot of things that we could do, and I think the spreads, the measure that we derived is actually a first step, but it's an important step in exactly that direction. So I think I'm going to stop here.